Okay, this is problem 15.9, and it's focused on the stockholders' equity section of the balance sheet. And we are given the following is a summary of all relevant transactions of Vicario Corporation since it was organized in 2017. In 2017, 15,000 shares were authorized. 7,000 shares of common stock and $50 par value were issued at a price of $57. In 2018, 1,000 shares were issued as a stock dividend when the stock was selling for $60 per share. 300 shares of common stock were bought in 2019 at a cost of $64 per share. These 300 shares are still in the company treasury. In 2018, 10,000 preferred shares were authorized, and the company issued 5,000 of them, $100 par value, at $113. Some of the preferred stock was reacquired by the company and later reissued for $4,700 more than it cost the company. The corporation has earned a total of $610,000 in net income after taxes and paid out a total of $312,600 in cash dividends since incorporation. So I think what I want to do is start out with some T accounts, and then once we get those balances, then we can do the stockholders' equity section, which is the primary aim of this problem. So let's start with, in 2017, 15,000 shares were authorized and 7,000 shares of common stock, $50 par, were issued at a price of $57. Okay, so 7,000 shares were issued at a price of $57 and they have $50 par. So I'm going to create this cash T account, and we have 7,000 shares times 57, and that's going to give us 399,000, and that's going to be 399,000. And I'll just put a little A. I know it doesn't really refer to anything, but I'm going to put a little A there. And it's going to be a credit for 7,000 times 50, or 350,000 to common stock. And the common stock is going to be this credit for 350,000. And we'll call that A as well. And then we're going to have additional paid in capital common stock, and that's going to be for the extra 49,000, and that's also going to be in A. So that's our first journal entry. The rest of it, about the 15,000 shares authorized and issued, authorized is really notation. It says in 2018, 1,000 shares were issued as a stock dividend when the stock was selling for $60. And here we're going to say we're going to have a dividend comes out of retained earnings. And I know we haven't got any credits in there yet, but I'm going to go ahead, and because I know that there's going to be a bunch of net income down here, I'm going to debit retained earnings for $60, the fair value times 1,000, or we'll call that B, 60,000. And it's going to be a credit to common stock for 1,000 times 50, or 50,000, and B. And an additional paid in capital, and that's 49,000. 50,000, I'm sorry. Let me get that straightened out for you. We'll make that a little bit smaller next time. And that's the difference between 60,000 and 50 is going to be a 10,000 additional paid-in capital in B. Okay. Now let's go back up here. Then it says 300 shares of common stock were bought in 2019 at a cost of $64 per share. So that's going to be 300 times 64. $19,200, and that's going to be C. 19,200, and we're going to put that in treasury stock. We're recording this on the cost method, and that's going to be a debit to treasury stock at cost, 19,200, and that's for 300 shares. C, 300 shares. Okay. And they're still in the treasury. Now in 2018 we had 10,000 preferred shares were authorized, and the company issued 5,000 of them, $100 par value, at 113. Some of the preferred stock was okay. So let's just do that. That's going to be 5,000 at 113 times 113. I come up with 565,000. We'll call that D. 565. And we're going to credit preferred stock, and that's going to be 5,000 at 100, or 500,000. Credit 500,000. That's D. And then we'll also have additional paid-in capital preferred, and that's going to be for the extra 565 minus 500, or 65,000 in D. Now, some of this was reacquired by the company and later reissued for $4,700 more than it cost the company. So we don't know what went through in terms of treasury stock common. This is the common treasury stock. We have that. We know about that. But we don't know what happened to the treasury stock preferred. All we know is that there is additional paid-in capital treasury stock preferred, and that is because it was sold for more than $4,700 more than it cost the company. So it has a net effect like this: a credit for $4,700, we'll call that E, and a debit, doesn't really matter, but the net effect is going to be an E, a debit for $4,700. The cost goes through treasury stock preferred, but since it was all sold, there's no real effect there. All we know is that in the end we sold it for $4,700 more than we paid, right here. So then it says that the company has earned a total of $610,000 in net income. We do have retained earnings. Where did we put the retained earnings? Over here. That is a net credit, $610,000. We'll call that F. And the offsetting debit is going to be to sales and netted with credits to all of the expenses. And then paid out a total in cash dividends, $312,600, and we'll call that G. And that's going to be a debit 312,600 to retained earnings. And G. So we have a total here, 372,600 from 610,000. Let me get my other 610,000 minus 372,600. I come up with 237,400. Now I'm just calculating the balances here. This is going to be 59,000. This is going to be 400,000. 65 is a balance. 4,700 over here. And cash we don't care about so much because we're not going to, that's not in the stockholders equity section, but we do have 19,200 here. And that's going to give us the balances that we need in order to do our stockholders equity section. So now I'm going to, it's Vicario Corporation. Balance sheet. As of, or we'll call this a partial balance sheet because it's not the whole thing, as of December 31, 2019. We're going to start out with paid in capital. Oh, this is, I should put in there, this is that we're doing stockholders equity. Let me put that up here. Stockholders equity. Let's put equity in there now. We'll put that up above. And then we have paid in capital. And then we're going to start with our preferred stock. And I'll put that in here, preferred stock. And that is $100 par. And we have 10,000 shares authorized and 5,000 shares authorized. 5,000 shares issued and outstanding. And so we're going to take 5,000 times 100, and that's going to be our 500,000, which is our preferred stock up here, 500,000. Okay. We also have common stock. And this stock is $50 par. We have 15,000 shares authorized. $8,000 shares issued. And 7,700 shares outstanding. So here, and it's the issued number that we multiply by the par value. So 8,000 times 50, and that's going to be times 5 is 40,000, 400,000, and that's going to be our 400,000 right there. Then we have paid in capital. Let me erase that for a second. Additional paid in capital, and I'm going to put it with a colon. We'll have preferred stock, and that's going to be 65,000. We have common stock, and that's going to be let's see. The common stock additional paid in capital should be the 57. The common stock additional should be this 59,000 here. And then we have from treasury stock preferred. This is also additional paid in capital, but remember, this is when those shares that we bought and then later resold at additional 4,700 above what we paid for it, and that's going to be additional paid in capital. And this is the total of this is going to be total contributed or paid in capital. Let me erase that. Oop, wrong button. We'll call this paid in capital. Add those all up, and 965,74, 1,024, 1,028, 700. And then we also have retained earnings. And retained earnings, which is our common stock, or sorry, never mind. Retained earnings is going to be the 237,400 there. The 237,400. Blow that up a little bit here. And then we also have the treasury stock. And the treasury stock is at cost 19,200. And that is common treasury stock. At cost. And that's a reduction. It's a debit balanced. So we're going to say 19,200, and we're going to put it in parentheses right here. And then our total stockholders equity is going to be the 1,028,700 plus the 237,400 minus 19,200, and when I did that, I come up with 1,246,000 900. And since that's the end of, that's really all we're doing here, that is the answer that to problem 15-9. This problem right up there, 15-9.